Imagine being able to tap into some of the fastest-growing economies in the world, places like China, India, and Brazil, where the potential for wealth creation is enormous, and the opportunities are still emerging. If you're looking to build wealth in ways you haven't considered yet, you've come to the right place. This is Task and Tune, where we explore global financial strategies. And best of all, this is an audio-first channel. You can listen while you're on the go, at the gym, driving, or even while doing your work. Let's dive into today's deep topic: how to build wealth in emerging markets. In this video, we'll cover the fundamentals of emerging markets, why they offer such immense potential, and how you can strategically invest in sectors like real estate, stocks, entrepreneurship, and more. We'll also discuss the risks and how to mitigate them, with real-world examples to guide you. What are emerging markets? Emerging markets are countries that are transitioning from developing to developed. They have high growth potential, but come with their own set of risks. Think about economies like China, India, Brazil, Russia, and even some parts of Africa and Southeast Asia. Key features of emerging markets: high GDP growth. These markets typically have a much higher growth rate than developed economies. Urbanization. Rapid urbanization in countries like India and Indonesia is driving demand for infrastructure, housing, and services. Expanding middle class. As incomes rise, so does the demand for goods, services, and financial products. Why emerging markets matter? Emerging markets are crucial because they represent the future. For decades, we've seen developed markets slow down in growth. But in emerging markets, the upside is huge, driven by industrialization, population growth, and urbanization. Take China, for example. In the 1980s, China was predominantly rural and agrarian. Fast forward to today, and it's a manufacturing and technology powerhouse, with cities like Shanghai and Shenzhen leading the charge. Investors who recognized this shift early on have seen incredible returns. Why emerging markets offer huge potential. The potential for higher returns. One of the most attractive aspects of emerging markets is the potential for higher returns. The rapid pace of economic growth means there's more room for companies and sectors to scale up quickly. Diversification. Investing in emerging markets also allows you to diversify your portfolio. Developed markets like the US or Europe might experience slower growth or even stagnation. But because emerging markets are often not as correlated with developed markets, they provide a hedge during global economic downturns. Alibaba and Tencent in China. In the early 2000s, China's technology sector was still developing. Companies like Alibaba and Tencent entered the scene and grew exponentially, driven by the massive demand for online commerce and mobile payments. Investors who got in early saw astronomical returns, as Alibaba went public in one of the largest IPOs in history. Real estate investment in emerging markets. Why real estate? One of the best ways to build wealth in emerging markets is through real estate. As cities grow, the demand for housing, offices, and infrastructure increases dramatically. Real estate in emerging markets is often undervalued compared to developed countries, but the growth potential is enormous. India. Cities like Bangalore, Mumbai, and Hyderabad are booming due to their tech industry and growing middle class. Real estate values are increasing rapidly, but prices are still relatively affordable compared to global cities like New York or London. Vietnam. As manufacturing shifts away from China, Vietnam has emerged as a major player in industries like electronics and textiles, making its industrial and residential real estate markets a lucrative opportunity. Bangalore's real estate boom. Just 15 years ago, Bangalore was known as a quiet city. Today, it's often referred to as the Silicon Valley of India. Property values have more than doubled, driven by tech companies and a growing workforce. Investors who saw this trend early on have reaped significant returns. Challenges in real estate. Of course, real estate in emerging markets comes with its own set of risks. You'll need to navigate complex property laws, deal with potential political instability, and understand local market dynamics. But for those who can overcome these challenges, the rewards are significant. Stock market investment in emerging markets. Why stocks? Stocks are another great way to capitalize on emerging markets. Many of the companies in these markets are still in high-growth phases, which means there's more potential for price appreciation compared to more mature companies in developed markets. Top stock exchanges in emerging markets. Bombay Stock Exchange, India's largest exchange, offering opportunities in tech, pharmaceuticals, and consumer goods. Shanghai Stock Exchange. China's tech and manufacturing sectors are heavily represented here, with companies like Alibaba and Tencent leading the charge. How to invest in emerging market stocks. Direct investment. If you have access to international brokers, you can directly invest in stocks listed on emerging market exchanges. American Depository Receipts, ADRS. These allow you to invest in foreign companies via U.S. exchanges. For example, you can buy ADRs for Alibaba or Infosys on the NYSE. Mutual funds and ETFs. For those who want diversification across multiple emerging markets, funds like the iShares MSCI Emerging Markets ETF offer exposure to a broad range of companies. Risks. Stock investments in emerging markets are inherently riskier due to political instability, currency fluctuations, and market volatility. However, the potential upside often outweighs these risks for long-term investors. Entrepreneurship and small business in emerging markets. Why start a business in emerging markets? Emerging markets offer a perfect storm for entrepreneurship. With less competition, high demand, and growing consumer bases, starting a business can be incredibly lucrative. Key growth sectors. Technology. Startups in fintech, AI, and e-commerce are booming in countries like India, Brazil, and Nigeria. Consumer goods. The rising middle class in countries like Indonesia and South Africa is driving demand for everything from electronics to fashion. Agriculture. Agribusinesses in countries like Brazil and Kenya are seeing major growth as global demand for food and natural resources increases. Flipkart in India. Flipkart started as a small e-commerce company in India. It grew rapidly by addressing the unique needs of Indian consumers and was eventually acquired by Walmart for billions of dollars. Early investors and founders saw immense returns. Challenges in entrepreneurship. Starting a business in an emerging market requires an understanding of local laws, consumer behavior, and logistics. But with the right strategy, the potential is enormous. Private equity and venture capital in emerging markets. Why private equity and VC? Many startups in emerging markets are still in their early stages, which means private equity and venture capital can yield massive returns. Investors are looking for the next big thing in these markets. Growing startup ecosystems. India, with unicorns like Byju's and Paytm, India has become a hotspot for venture capital. Brazil. Fintech companies like Nubank are transforming the banking sector, providing opportunities for early-stage investors. Challenges. Private equity and venture capital investments come with higher risks, as many startups may fail. But the upside is that successful companies can grow exponentially in these fast-paced markets. Risks in emerging markets. Political risk, political instability can be a major concern in emerging markets. Changes in government or policy can drastically impact the business environment. Currency risk. Fluctuations in currency values can also affect your returns. For example, a weakening local currency against the US dollar could erode profits. Cultural and legal differences. Doing business or investing in emerging markets often requires an understanding of local culture and regulations. Navigating these effectively is key to success. How to mitigate risks. Diversification. Spread investments across multiple regions and sectors to reduce risk. Local partnerships. Collaborating with local experts or firms can help you navigate regulatory hurdles. Currency hedging. Using hedging strategies can protect against currency fluctuations. Emerging markets offer incredible opportunities for building wealth. Whether it's through real estate, stock market investments, entrepreneurship, or private equity, the potential upside is significant. However, these opportunities come with risks, and it's crucial to approach them strategically and with the long term in mind. If you found this information valuable, be sure to hit that like button, subscribe to the channel, and tap the bell icon so you never miss an update from Task and Tune. This really helps us grow our community and continue to provide insightful content.